A framed college diploma hangs neatly on Emily's apartment wall. It represents 4 years of hard work, late nights, student loans, and the hopes of an entire family. When she crossed the graduation stage, everyone applauded not only her achievement, but the future they believed it guaranteed: a stable career, financial independence, a life that would be easier than the one her parents had known. 6 months later, the picture looks different. Emily has found a full-time job with a respectable salary. She pays her bills on time. She contributes to her retirement plan. She does everything that previous generations said she should do. Yet at the end of each month, little seems to remain. Rent absorbs a large share of her paycheck. Student loan payments quietly return. Health insurance, groceries, transportation, and everyday expenses consume the rest. She is moving forward, but the feeling of arrival never comes. Her story is no longer unusual. Across America, millions of graduates are entering adulthood with more education than any generation before them. They possess valuable skills, ambitious goals, and access to careers that once seemed out of reach. Yet many also carry heavier financial obligations, face higher housing costs, and enter labor markets where a college degree has become less of a competitive advantage and more of a basic requirement. The question is not whether college still opens doors. The deeper question is whether those doors still lead to the kind of economic opportunity previous generations expected, or whether the price of reaching them has quietly changed the journey itself. For much of the 20th century, earning a college degree represented one of the clearest paths to upward mobility in America. Parents encouraged their children to pursue higher education, not simply because learning had intrinsic value, but because it was widely viewed as one of the safest long-term investments a family could make. Tuition was relatively affordable. Student debt was uncommon for many households, and a bachelor's degree often distinguished applicants in a growing labor market. Graduation marked the beginning of adulthood. A steady job frequently led to financial independence within a few years. Young professionals could realistically expect to rent an apartment, purchase a first home, start a family, and gradually build wealth over time. College was never a guarantee of success, but it significantly increased the probability that each generation would enjoy a higher standard of living than the one before it. Over the past several decades, however, the economics surrounding higher education have changed dramatically. Tuition has increased far faster than general inflation, while many students now rely on loans to finance degrees that previous generations often paid for with part-time work or modest family savings. At the same time, housing costs have risen sharply in many metropolitan areas where college graduates are most likely to find employment. Healthcare expenses, transportation costs, and everyday living expenses have also become a much larger share of early career income. The result is a different starting point for today's graduates. Many begin their careers with greater educational attainment than their parents, yet also with larger fixed financial obligations before they have accumulated meaningful savings or assets. This transformation becomes even more significant when viewed alongside changes in the labor market itself. A bachelor's degree once differentiated candidates. Today, in many industries, it simply establishes eligibility. Economists often describe this phenomenon as asterisk credential inflation. Positions that previously required experience or vocational training increasingly list a bachelor's degree as a minimum qualification. Some professional roles now prefer master's degrees for work that earlier generations entered with 4-year degrees alone. The value of education has not disappeared. Instead, the educational baseline has shifted upward. As more people obtain college degrees, employers often raise educational expectations without necessarily increasing compensation at the same pace. Graduates therefore invest more time and money merely to compete for opportunities that once required fewer credentials. This does not mean higher education has become worthless. On average, college graduates still tend to earn more over their lifetimes than those without degrees. They generally experience lower unemployment rates and greater career flexibility. But averages tell only part of the story. The pathway between graduation and financial security has become longer, more expensive, and considerably less predictable than it once was. For many young professionals, the first decade after college is no longer primarily about building wealth. It is about managing obligations. Student loan payments compete with retirement savings. Rent competes with down payments. Healthcare premiums compete with emergency savings. Every financial decision becomes an exercise in balancing immediate necessities against future goals. This changing reality also affects families long before students ever step onto a college campus. Parents increasingly save for tuition years in advance. Some delay retirement to help finance their children's education. Others encourage less expensive colleges or alternative career paths, not because they value education less, but because they have become more aware of its growing financial cost. The conversation surrounding college has therefore changed. It is no longer centered solely on learning or opportunity. It increasingly revolves around return on investment. That shift reveals a deeper structural question. If higher education remains one of the most important investments a family can make, why are so many graduates and so many parents becoming less certain that the investment will produce the future they once expected? To understand that uncertainty, it helps to look beyond national statistics and examine the experience of one graduate navigating the realities of modern adulthood. When Emily accepted her first full-time job after graduation, she believed she had reached the milestone she had been working toward for years. The offer came from a respected marketing firm in a growing metropolitan area. The salary was $63 a year, higher than what either of her parents had earned at the same age when adjusted only by the number on the paycheck. Friends congratulated her. Family members told her she had a bright future ahead. For a brief moment, it felt as though everything was unfolding exactly as planned. Then the first paycheck arrived. The gross income looked encouraging. The amount that reached her bank account looked considerably different. Taxes reduced it. Health insurance premiums came next. Retirement contributions. something she knew she should begin immediately, claimed another portion. By the time the remaining balance appeared, it already felt smaller than the salary she had celebrated only weeks earlier. That was before any monthly bills had been paid. Rent for a modest apartment shared with 2 roommates consumed the largest expense. Student loan payments resumed after the grace period ended. Car insurance had increased since the previous year. Fuel costs fluctuated unpredictably. Groceries seemed slightly more expensive almost every month. Internet service, phone bills, utilities, professional clothing, occasional medical expenses. None of these costs seemed extraordinary on their own. Together, they quietly reshaped her budget. Emily wasn't living extravagantly. She rarely traveled. She drove a reliable used car. She prepared most of her meals at home. She tracked her spending through budgeting software and resisted unnecessary purchases. By nearly every traditional measure, she behaved responsibly. Yet, financial progress felt surprisingly slow. One evening, while reviewing her monthly budget, she calculated how long it might take to save enough for a down payment on a modest home. Even with consistent saving, the timeline stretched much further into the future than she had imagined during college. Housing prices in her city had continued rising faster than her savings. Every year she postponed buying, the goal seemed to move a little farther away. The realization unsettled her. She wasn't falling behind because of reckless spending, she was falling behind a moving target. The same pattern appeared elsewhere. She wanted to build an emergency fund, covering 6 months of expenses. Before reaching that goal, unexpected car repairs erased several months of savings. She hoped to increase retirement contributions. Instead, rising rent required those dollars elsewhere. She considered returning to graduate school, but hesitated after calculating the additional tuition and the possibility of taking on even more debt. Each financial objective competed with another. Progress in one area often meant delaying another. Her parents watched these decisions with quiet concern. Neither had graduated from college. They had worked steadily, purchased their first home in their late 20s, and raised a family on incomes that would appear modest by today's standards. They never imagined their daughter, armed with a university degree, a professional career, and a higher salary, would struggle to achieve milestones they had reached decades earlier. They did not question Emily's work ethic. They questioned the economics. Had life simply become more expensive? Or had the relationship between education and opportunity fundamentally changed? Emily began asking herself the same question. She noticed that many of her colleagues shared similar experiences. Some postponed moving out of shared apartments despite respectable incomes. Others delayed marriage because combining finances still did not make homeownership realistic. Several continued living with parents while paying down student loans. Nearly all described feeling financially responsible without feeling financially secure. The conversation rarely centered on luxury. It centered on timing. When will things finally get easier? No one seemed certain. Emily still believed her degree had value. It had opened doors. It had introduced her to mentors, colleagues, and career opportunities she otherwise might never have found. She did not regret earning it. What she questioned was the assumption that graduation alone marked the beginning of financial independence. Increasingly, it seemed more like the beginning of a much longer transition into adulthood. And Emily's experience reveals something larger than one person's financial journey. It reflects a structural shift affecting millions of graduates across the country. The challenge is no longer simply earning a degree. It is navigating an economic system in which the cost of obtaining opportunity continues to rise long after graduation day has passed, to understand why that burden has become so widespread. We must look beyond individual choices and examine the systems that quietly transformed higher education from an affordable investment into one of the defining financial commitments of modern American life. Emily's story is often described as a personal challenge. Study harder, choose a different major, spend less, budget better. While personal decisions certainly matter, those explanations overlook a broader transformation that has unfolded over several decades. The financial experience of today's graduates is shaped not only by individual choices, but by multiple systems that have evolved simultaneously. Higher education did not become more expensive because of a single event. It became more expensive because several long-term trends reinforced one another. Tuition increased steadily as universities expanded campuses, invested in new facilities, technology, student services, research programs, and administrative operations. Many of these investments improved the educational experience. They also contributed to rising operating costs, which were gradually reflected in tuition. At the same time, the widespread availability of student loans made those higher prices easier to finance. Instead of paying the full cost immediately, students could borrow and repay over many years. This expanded access to higher education for millions of Americans. Yet, it also changed the timing of the financial burden. Previous generations often completed college before beginning adult financial obligations. Today's graduates frequently begin adult life already carrying one of their largest long-term debts. That debt rarely exists in isolation. It arrives just as other expenses begin accelerating. Graduates enter housing markets where prices have risen much faster than incomes in many metropolitan areas. They begin contributing to retirement earlier because pensions have largely disappeared, placing greater responsibility on individuals. Health insurance deductibles and out-of-pocket medical costs consume larger portions of household budgets than they once did. Transportation costs remain significant in communities where reliable public transit is limited. Even seemingly minor recurring expenses, from professional software subscriptions to internet service and mobile phone plans, have become permanent components of modern financial life. None of these obligations necessarily feels overwhelming on its own. Collectively, however, they reshape the economics of early adulthood. The result is a gradual reduction in financial flexibility. Perhaps the most important structural change is something economists refer to as credential inflation. Several decades ago, Earning a bachelor's degree distinguished applicants from much of the labor force. Today, bachelor's degrees are substantially more common. This represents an extraordinary educational achievement for society. But it also changes employer expectations. As more candidates possess college degrees, employers increasingly use higher educational requirements as an initial screening tool. Positions that once accepted applicants with experience or vocational training may now require bachelor's degrees. Some jobs that previously required bachelor's degrees now prefer master's degrees or additional certifications. The educational ladder continues rising. The economic reward, however, does not always increase proportionally. This creates a subtle but powerful shift. Education remains valuable. Yet more education is often required simply to compete for opportunities that previous generations entered with fewer credentials. The degree still opens doors. It simply opens different doors than it once did. Meanwhile, families are adapting to this changing reality. Parents begin saving for college when children are still in elementary school. Some work additional years before retirement to help cover tuition. Others refinance homes or reduce retirement contributions to avoid larger student loans for their children. Higher education therefore affects multiple generations simultaneously. Students carry debt. Parents carry responsibility. Grandparents sometimes contribute financial support as well. The cost of one degree often extends far beyond the individual earning it. This transformation also changes how young adults define success. Previous generations often measured progress by milestones. Graduation, a first apartment, a first home, marriage, children. Today, those milestones increasingly depend on financial calculations rather than age alone. Buying a home may require delaying graduate school. Starting a family may require paying off student loans first. Changing careers may require postponing retirement contributions. Each decision affects another. The path through adulthood becomes less linear and considerably more interconnected. None of this suggests that higher education has lost its importance. On average, college graduates continue to enjoy higher lifetime earnings and lower unemployment than many workers without degrees. Knowledge, specialized skills, and professional networks remain powerful advantages in a changing economy. The question is not whether education still creates opportunity. The question is why that opportunity increasingly arrives alongside greater financial complexity. For millions of Americans, earning a degree no longer marks the end of financial preparation. It marks the beginning of a much longer period of balancing opportunity against obligation. And as that balancing act becomes more demanding, another change quietly emerges, one that cannot be measured by tuition bills or salary statistics alone. It begins to reshape how an entire generation thinks about adulthood, success, and the future itself. When Emily was growing up, college represented more than an education. It represented certainty. Teachers described it as the foundation of a successful life. Parents saw it as the greatest gift they could provide. Guidance counselors repeated a familiar promise: work hard, earn a degree, and the future would take care of itself. For many students, that belief shaped their entire adolescence. But somewhere between graduation and adulthood, expectations began colliding with reality. Emily had imagined that receiving her diploma would mark the beginning of financial independence. Instead, it marked the beginning of financial management. Every month required careful planning. Every unexpected expense delayed another goal. Every major life decision seemed connected to a spreadsheet. This growing disconnect between expectation and experience has become one of the defining psychological pressures facing young Americans. It is not simply about debt. It is about timing. Previous generations often viewed their 20s as a decade of building. Today's graduates increasingly spend those same years stabilizing. Instead of saving for a home, many are paying down loans. Instead of building investments, they are creating emergency funds. Instead of planning families, they are calculating affordability. The sequence of adulthood has quietly changed. These delays are rarely the result of a lack of ambition. If anything, today's graduates are among the most educated and professionally prepared generations in American history. They enter the workforce with valuable skills, technological fluency, and a willingness to adapt. Yet many still describe feeling as though they are constantly trying to catch up rather than move ahead. This creates what might be called the asterisk expectation gap, the gap between what people were told education would provide and what it actually delivers in today's economy. The degree still creates opportunity, but the timeline toward financial security has become longer, less predictable, and considerably more expensive. Parents experience this shift as well. Many who once viewed paying for college as the final major investment in their children's future now discover that support often continues long after graduation. They help with rent. They assist with down payments. Some even welcome adult children back home while they build financial stability. The transition into independent adulthood becomes increasingly gradual rather than immediate. Over time, these experiences reshape expectations for an entire generation. Young professionals become more cautious about taking career risks. Marriage is postponed until finances feel stable. Home ownership becomes a distant objective rather than an early milestone. Even optimism changes. Success is no longer measured by how quickly life improves after graduation. It is measured by how effectively people can manage growing financial obligations. Perhaps the most significant consequence is not economic, but emotional. When each milestone arrives years later than expected, progress becomes difficult to recognize. People may earn more than their parents did at the same age. They may possess greater education and stronger careers. Yet many still feel as though adulthood has not fully begun. That feeling reveals something deeper than individual frustration. It suggests that the promise surrounding higher education has not disappeared, but it has been fundamentally reshaped by the economic systems surrounding it. And perhaps the most important question is no longer whether college still opens doors. It is whether those doors still lead to the same future that generations of Americans were taught to expect. A college degree still carries enormous value. It opens doors to knowledge, professional networks, specialized careers, and opportunities that might otherwise remain out of reach. For millions of Americans, higher education continues to be one of the most meaningful investments they will ever make. But the economics surrounding that investment have changed. The diploma itself has not become less important. What has changed is the financial landscape graduates enter once the celebration is over. Higher tuition, student debt, rising housing costs, healthcare expenses, and delayed financial milestones have quietly altered the relationship between education and economic mobility. For previous generations, college often represented the beginning of financial independence. Today, for many young Americans, it marks the beginning of a longer journey toward it. Perhaps this is the deeper structural shift. The promise of higher education was never simply about earning a larger paycheck. It was about creating greater freedom. The freedom to build a life, purchase a home, start a family, change careers, and imagine a future with confidence. Those possibilities still exist, but they increasingly require more time, more planning, and greater financial resilience than they once did. The question, then, is not whether college still matters. It almost certainly does. The more important question is whether the systems surrounding higher education still allow that investment to deliver the same sense of opportunity that generations of Americans once expected, and if the pathway into adulthood continues growing longer and more expensive. The future of economic mobility may depend not only on education itself, but on rethinking the cost of reaching it.